Hey, what's up y'all? Welcome to another stock watch list as we're starting a new month. For this video, I'm taking a look at the APM business model, also known as application performance monitoring in the tech world. The reason I want to cover this? Well, downtime is a business's worst problem, as each second to minute to hours costs serious revenue. The worst impact is a stain on the business's reputation. To understand these kind of sudden interruptions in a digital environment, most companies look to find a reputable APM provider. This tool ensures systems are healthy, and when a problem does come up, the right person is notified and empowered with enough data and understanding to fix the problem as soon as possible. Additionally, this is how companies use IT metrics to extract business value. From gauging performance to identifying failures and areas of code improvement, it's how developers can see what's working and what's not, all in real time. If you're new to the channel, do me a solid favor and hit that subscribe button and bell notification to keep up with my future videos. Hit the like button as well, as it really helps with the YouTube algorithm, and others can join the patient mindset movement too. Also follow me on my social media if you want at Patient Mindset to keep up with my thoughts and posts from time to time. Now the first company I'll be covering is Datadog, ticker symbol DDOG. Founded a decade ago and headquartered at New York and the East Coast, Datadog provides monitoring for servers, databases, tools, and services through the data analytics platform. It's been a fast-growing company, having won many awards like Best Place to Work, for example, in the past couple years. Let's take a look at where they're at today. I will be mostly focusing on APM service for most of the video, but I do want to clarify that the companies I'm discussing have many different types of services, even if it's a small part of their product line overall. Datadog offers a lot under the APM umbrella. What separates them from the competition is the fact that they provide everything in one single product, so customers don't have to use a different group of vendors every single time. From infrastructure management and network monitoring, to mobile monitoring and log management, Datadog lets the user see across many systems and apps altogether. Now this is really good because depending on your company type, chances are you're using a different software as a service platform and cloud platform every single time. To get complete visibility on monitoring and solving any sudden problems, you want a platform that can track end-to-end performance while tracing errors too. Data can be logged for any external application, and with this, you get real-time dashboards to interact with data slicing, graphing, and computing. In the end, Datadog simply has really diverse functionality to plug and play monitoring for most popular tools already being used. Lots of companies in many industries are customers of Datadog. Some of them are public while others are still private startups. This goes to show that Datadog's customer suite is not just comprised of one area, or the fact that they only cater to legacy companies. Rather, mostly younger companies that haven't been around too long are actually depending on them to monitor performance. DraftKings, Peloton, PagerDuty, and Wayfair have all recently IPO'd, and they're fitting examples of these young companies I'm talking about. Asana, Instacart, and Coursera are still private companies, and have actually been doing really well this year, considering their product usage has increased with most people staying at home right now. Jeff Bezos' aerospace company, Blue Origin, is known to be very secretive and very cautious of who they work with. Yet here we are. They trust Datadog software to monitor their current projects. Taking a look at Datadog's stock chart, we're seeing some limited past performance, as next month the stock is barely approaching its 1-year anniversary since IPO. Still, within almost a year, it's grown 132%, more than doubling the price after the stock initially traded pretty stagnantly in the beginning. Since the March crash, this stock has been on a roll due to positive earnings the last 2 quarters, and their business being heavily supported by more companies needing APM services, as online traffic has skyrocketed. With earnings this Thursday, I'm curious to see how the stock performance for Q2 will be, and I'll be waiting till after earnings to potentially buy into the company. Even if I have to end up paying for more, I'm looking at the long-term picture here, and I'm willing to average down if the premium drops every now and then. The trading range for Datadog has been in between $80 to $95 for the past month. The bull case being 100 plus with blowout earnings and good company updates, or back under the $80 range if decent earnings end up painting the current picture to be overvalued. But with a market cap of $28.24 billion, I still believe the company has a long way to go, especially as they're getting closer to consistent profitability with time. According to a research report by Advanced Market Analytics, the application monitoring industry is expected to keep exponentially growing till 2025, due to the service improving productivity for most tech companies, followed by reduced downtime and losses. Total shares outstanding is about 176.5 million, which is really small if you want your shares to have a bigger pie in the APM market. For reference, Oracle and Cisco are both legacy companies offering APM services of their own. However, Oracle has about 3.3 billion shares, and Cisco has 4.25 billion shares. So the rate of growth will be much smaller, considering their share performance is also heavily influenced by dozens of other markets they're involved in. Looking at Datadog's 10K statement, we can see a summarized performance for the last couple years. Revenue has managed to increase every year, complemented by an increase in cost of revenue, of course, meaning their reinvestments have been paying off in terms of growth and expansion at the cost of profitability. While this isn't a guaranteed indication for the future success of the company, it's still a good sign at least that Datadog has been increasing their gross profit even before they raised IPO funding last year. Sales and marketing is the biggest of their operating expenses, with costs increasing as they're trying to enter different industries. Research and development costs are heavy too, suggesting lots of planned improvement to their software. For now, you can see the fluctuations in earnings per share, resulting in losses each year. Of course, it won't be stable until Datadog is operating at optimal efficiency, so we'll honestly have to see more quarterly reports in time to make a better judgment on how well the business will continue doing financially. With upcoming earnings, they will have to significantly beat earnings estimates to justify their current price run-up. In the media, Datadog keeps to itself and doesn't really get involved with controversies unlike some other data-involved companies. Part of the reason is with their culture, which you'll get a good idea of, especially on their website. Dubbed Pup Culture, Datadog prides itself in doing more outside of their company boundaries, and they're involved with the community especially. From sponsoring hackathons and learning weeks to promoting women in tech, Datadog strategically finds the best talent for their company through this as well. They've been recognized in 2020 as the winning choice for IT monitoring by Gartner. Datadog has been continuously reinvesting into their product, and they're taking the growth approach very seriously, sacrificing current profitability, hoping for wider margins in the future. And this can be seen as they're growing their service compatibility with giants like Amazon AWS, alongside Microsoft's Azure, Alibaba Cloud, and much more. I'm really excited and looking forward to see where they'll end up at many years from now. The second stock in my watch list is Dynatrace, ticker symbol DT, a company not as trendy as Datadog, but still offering strong competition when it comes to application monitoring market. What separates their platform is their use of AI, specially built for multi-cloud environments. Once a user installs Dynatrace, the platform auto-discovers the environment and starts performing, looking not just for data but insights in app performance and the experience of its enterprise customers' user base. The business model is similar to Datadog, in which they heavily focus on infrastructure management with a specialization in the underlying hybrid cloud infrastructure. Monitoring web and mobile data, Dynatrace provides complete operations and data visibility. They have two patented technologies, PurePath for capturing all code-level transactions end-to-end, and PureStack, which checks guest and host infrastructure health to diagnose in real time. Just like Datadog, Dynatrace has a well-developed partner ecosystem in which they can integrate and collaborate with existing products like AWS, Azure, Google Cloud, and Red Hat's OpenShift. As of this year, Dynatrace has over 2,700 customers in 80+ countries in many industries, as you can see here, like Kroger and U-Haul in retail, Experian and KeyBank in financial services, Carnival in travel, and Dish, SAP, and Samsung in software and hardware. Big enterprises and corporations make up a majority of their top clients, unlike Datadog, which, as I mentioned before, serves more startups and recently IPO'd companies. While I like the growth potential in Datadog's customer base, I'll have to give credit to Dynatrace's sticky revenue potential, which has grown over $750 million annually just from legacy companies that will continue being dependent on them. Taking a look at Dynatrace's stock chart, it's trading at less than half of the price of Datadog, in the $30 to $45 range. The company IPO'd 1 month before Datadog did, and has traded with lots of volatility the past year. It's up 62% from the IPO price, so there is a potential upside depending on the next few earning reports. We can see the market cap is at $11.85 billion, with outstanding shares at 281.6 million, hence the valuation difference from Datadog, which has a higher stock price at more than double the market cap, of course with a lower amount of outstanding shares too. Taking a look at the recent 10K report for Dynatrace, we can see revenue from subscription and servicing was at its highest this year. License-wise though, not so much, which makes sense in my opinion. Some companies may be choosing to opt for a subscription, rather than paying for a whole license upfront, especially if their goal is just to temporarily monitor application performance during this limited COVID era where most people are working and interacting with technology. Of course, cost of revenue will complement higher revenue, and just like Datadog, Dynatrace has the heaviest operating expenses in sales and marketing. However, they do spend a little bit more on general and admin costs over research and development, something Datadog does the opposite of. General and admin expenses can include things like legal, insurance, human resources expenditure, and even costs related to IPOing. So it's not too much of a big red flag that they're spending more here than R&D. We'll have to continue monitoring how their operating expenses change over time, as they'll have to significantly cut down on this while increasing revenue to maintain healthy margins if they plan to compete long-term with the likes of Cisco, for example, which is already a very highly profitable company. In the media, much like Datadog, Dynatrace mostly gets coverage on their product and vendor partnerships. They've also won an award from Gartner 10 consecutive times for their dominance in application performance monitoring. Combining this with AI enhancement, their product is being used to help a wide variety of cases, from medical trials to cloud-native environments. It's definitely a good thing for a stock to be getting low-key coverage like Datadog and Dynatrace get. You don't always want your investment in the spotlight, as you'll have to manage both positive and negative media coverage, like controversial stocks often face. Some honorable mentions I wanted to include in this watchlist series are Cisco, specifically for their acquisition of Appdynamics, and the other company being New Relic. Appdynamics was acquired for $4 billion by Cisco back in 2017, especially for features like application mapping, transaction profiling, and real-time analytics. Cisco was looking to get into this kind of market that helps businesses understand the interaction between their products across servers and databases. Now, a few years later, Appdynamics is well integrated with Cisco's network infrastructure family, and they further automated their root cause analysis capabilities, dubbing it now as a cognition engine. They've expanded their servicing for popular platforms like AWS Lambda as well. However, like I mentioned before, I want a more direct exposure in APM, so that's the main reason why I'm not buying Cisco stock. New Relic is another software analytics company based in the Bay Area. They help make sense of the data from customer applications using an analytics-based platform to provide insights from all kinds of software metrics. This can be things like user clicks and interactions, mobile and web activity, transactional data, and much more. While New Relic's software is great, I'm not the biggest fan of their monetization strategy. In fact, this week, there was actually news released about a new pricing model they're implementing that is expected to drop the revenue by as much as 15 to 20 million for the rest of fiscal year 2021. Since most of their customers use the free tier offering, it's setting them up for tougher revenue growth for the next few quarters until they can improve seasonal sales again. I'm expecting share prices to trade in a downtrend and then sideways for a bit of time, and that's why I won't be buying the stock as well. That's it for all things application performance monitoring based. There's a lot of companies emerging in this high growth area, so I'll most likely make a part 2 of this video in the future. But as of now, Datadog and Dynatrace are on my watch list, and I'll be tuning into Datadog's earnings to make my decision based on how well they report and the guidance they provide for next quarter during the call. I really hope you enjoyed the video. Drop a comment on whether you'll be investing in this sector. And like always, feel free to leave any suggestions on future videos you want me to create or how I can improve as well. Thank you for watching, and I'll see you next time.